All right. Welcome back, everybody, to the Deep Dive. We're doing another one.
Yes. Excited.
And today we're going to try to go deep on financial sponsors.
Yeah.
I think we all have kind of a vague sense of what that is, but
Yeah.
we're going to try to really pin it down.
Yeah.
You guys sent in a bunch of really great excerpts on the topic.
Absolutely.
So we'll use those as jumping off points.
Yeah, very thought-provoking.
So, what is a financial sponsor? How do they operate?
Yeah.
Why should we care about understanding them?
Yeah.
All right, so let's jump right in.
Let's do it.
Maybe we can start with a basic definition.
Yeah.
Like, how would you explain what a financial sponsor is?
Sure. Yeah. I think sometimes the term financial sponsor sounds a little...
Opaque.
Yeah, it sounds a little kind of opaque, a little jargony,
Right.
But at its core, it's really firms that provide capital to businesses
Okay.
in exchange for ownership, or at least a significant stake in that company. So they're really kind of specialized investors. They're really focused on generating substantial returns, as opposed to just, steady dividends or something like that.
So they're not like the typical, buy and hold investor.
Exactly. Yeah, they're much more involved than that. They're not passive investors.
Gotcha.
Yeah. And so, that really kind of sets them apart from just like a bank issuing a loan.
Right. Yes. So
Different ball game.
What are the key differences there?
Well, I mean, financial sponsors are much more active than a traditional lender.
Okay.
So they're not just injecting capital, they're actually really getting involved in shaping the direction of the company.
I see.
So they're really leveraging their expertise to drive value creation.
Yeah.
So that could involve, influencing strategic decisions, guiding operational improvements, and even, securing board appointments.
It sounds like it's almost a partnership then.
Yeah, it's much more hands-on. You can think of it that way. It's more collaborative.
Okay, that makes sense.
Yeah.
So, do you have like a concrete example of how this plays out in the real world?
Sure. I think a good example would be if you think about a company that is looking to expand into a new market. A financial sponsor isn't just going to provide the funding.
Yeah.
They're going to help identify the target market.
Okay.
They might analyze the competitive landscape, develop a really robust entry strategy.
Gotcha.
And even connect the company with key players in that new market.
Wow.
So it's really about, it's really strategic guidance as much as it is about the financial backing.
Okay, that makes a lot of sense.
Yeah.
So how do they actually, how do they boost the value of these companies?
Yeah.
What are some of the levers that they pull?
Yeah. So, they employ a range of strategies, really, that are often tailored to the specific circumstances of each company. But, operational improvements are really a cornerstone of what they do.
Okay.
So that could involve implementing lean manufacturing principles to reduce waste, optimizing supply chains for efficiency, overhauling outdated technology systems. It's really about finding ways to make the business work better.
Okay, so it's not just about slashing costs.
No, not at all. It's really about finding ways to do things smarter and better.
Gotcha. Okay.
Yeah.
Is there a risk, though, that some of these changes, they could negatively impact employees or other stakeholders?
Absolutely. Yeah. While financial sponsors are aiming to maximize returns, they also recognize that long-term value creation depends on a sustainable and ethical approach.
Okay.
So they often work really closely with management to ensure that any changes are implemented thoughtfully, to minimize any adverse effects on employees.
Gotcha.
And the company's overall reputation.
Okay, so that's really interesting.
Yeah.
They're going into this with an exit strategy in mind.
Precisely, yeah. They're not looking to hold these companies forever.
Right.
Their ultimate goal is to realize a return on their investment. And so that requires a clear exit plan from the very beginning.
Yeah.
Yeah. So some common exit strategies would be, selling the company to a strategic buyer.
Right.
Taking the company public through an IPO, or even selling to another private equity firm.
Right. So choosing the right exit strategy.
Yeah.
Seems like a pretty complex decision.
Absolutely.
And what are some of the factors that they would consider?
Yeah, they consider a variety of factors. It's definitely not a straightforward choice.
Yeah.
But, they're looking at things like market conditions, the company's financial performance, obviously, potential buyer interest, and even regulatory factors. So Each scenario presents its own set of advantages and challenges.
Right.
So it really requires careful analysis and a lot of foresight.
That makes sense.
Yeah.
So, I mean, even before they get to that stage, they have to figure out which companies to invest in.
Right.
So the due diligence process, I imagine, is incredibly thorough.
Oh, absolutely. Yeah. It's extremely meticulous.
Yeah.
They're going to scrutinize a company from every angle.
Okay.
So they analyze financial statements, of course, but they go way deeper than that.
Yeah.
They're really delving into market dynamics, assessing competitive threats, examining customer concentration, evaluating regulatory risks.
Wow.
They're going to even scrutinize the management team.
Okay.
Their capabilities, their track record.
Yes.
So it's really about, mitigating risk as much as possible and making sure that they're investing in companies that have genuine growth potential.
Oh, it's like a deep dive within a deep dive.
It really is, yeah.
I mean, given all of that, given how sensitive all this information is,
right.
I mean, confidentiality has got to be like paramount.
Absolutely, yeah. Confidentiality is crucial throughout the entire process. Okay. It protects the company's proprietary information. It safeguards the sponsor's investment strategy, prevents competitors from, getting an advantage.
Yeah.
So, this level of secrecy allows for really candid assessments, open communication, and a much more efficient transaction process.
So it's all kind of happening behind the scenes.
Yeah, a lot of this stuff is behind the scenes for sure.
Interesting.
Yeah.
Well, I mean, it sounds like, financial sponsors.
Yeah.
They're not just passive investors.
No.
They're active partners.
You're active partners, yeah.
In shaping a company's future.
Absolutely.
I mean, their impact even goes beyond just individual businesses.
Yeah, absolutely. Their decisions can really ripple through entire industries, influencing trends, driving innovation, even shaping the broader economic landscape.
Right.
So it's often underestimated, their role, but it's undeniably significant.
Yeah, that's a really important point, I think.
Yeah.
Well, I mean, I think we've covered a lot here. We've talked about the hands-on approach, the exit strategies, the due diligence.
All the good stuff.
All the good stuff.
Yeah.
But, I think what's really interesting to think about is how this influence that financial sponsors have.
Yeah. How
it can kind of subtly reshape industries.
For sure.
And even entire, economic sectors.
It's true.
So it's something to keep in mind, as we kind of watch all this stuff unfold.
Yeah, absolutely.
So, thanks for listening, everyone.
Thanks for joining us.
And we'll see you next time on The Deep Dive.
See ya. Bye.
Bye.